Welcome to the third session of this workshop. The title of this session is The Past, Present and Future for GCC Investment in China and India. Unlike the other two sessions we've had, this is a special IISS briefing, and the reason for this is twofold. Firstly, that both presenters for this session are with the IISS Middle East office in Bahrain. And secondly, both are young researchers of the IISS, and this provides an opportunity for us to see their products in terms of the research that they've been doing. So it's an opportunity to showcase some of the work that is going on at the IISS Middle East office. I'm not going to say very much in terms of the context of this session, but just to add that this is clearly an important area for the future relationship between the GCC, India and China, and we will, in the next few minutes, get a better sense of how this is taking place. But let me turn to the first speaker, Mahmood Abdulla, who is the Geoeconomics and Strategy Research Assistant at the IISS. Mahmood will be focusing on the GCC investments in China and also the impact of the One Belt, One Road initiative that has been talked about at length in the last few weeks and months. Over to you, Mahmood.
Okay, thank you very much. So I'll be talking a little bit about the past, the present, and the future of GCC investments in China. And to start with that, I'll talk a bit about the nature of economic cooperation between the two, where it's been heading in for the past few years, and where it seems to be heading to in the future. Historically speaking, economic cooperation between GCC and China has been mainly limited to trade. And this trade has been dominant by energy exports from the GCC to China, as well as, among other things, manufactured goods from China to GCC. Since the beginning of 2000, a large structural shift has been witnessed in the region in terms of trade away from North America and Europe and more towards Asia, including China. And this has been, again, mainly energy exports from GCC, as well as, among other things, manufactured goods from China. While it has been dominant by trade, the GCC and China economic cooperation has been increasing significantly. It's expected that by 2020, the largest share of GCC exports will go to China, estimated to be around $160 billion, and Chinese imports to GCC are expected to reach $135 billion. Trade between the two has been mainly in terms of energy, but there have been other sectors as well. So in terms of oil, 3 out of China's top 10 oil suppliers are GCC countries: Saudi Arabia, United Arab Emirates, and Kuwait. Saudi Arabia alone is China's single largest oil trading partner, supplying about 15% of China's total oil imports. And a big reason behind that is China's large need for energy to fuel its demand and fuel its growth in the past few years. Natural gas has also been a big part of the equation when it comes to energy. Qatar, for example, went from supplying no liquefied natural gas to China in 2009 and before that to becoming its second largest supplier in 2013. China is now Qatar's fifth largest natural gas customer, accounting for 6.4% of its natural gas and LNG exports. However, cooperation between the two has not been limited to energy, and it had not been limited to trade. Cooperation between the two has also included contracts between the two countries and projects in the two regions. Between 2005 and 2014, Chinese companies won roughly $30 billion worth of contracts in the GCC, and this has been broad-based. Sectors of these contracts include energy, industrial, telecommunications, as well as retail and consumer goods. For example, in telecommunications, the GCC has been a significant market for the Chinese telecom company Huawei. In addition, the industrial sector has also been a significant part. In 2014, the $3.7 billion Wadi al-Shamal phosphate project in Saudi Arabia went to a Chinese company. And other sectors as well. For example, in Dubai, Chinamex helped develop the Dragon Mart in 2004 and is now involved in the Dragon City Mall in Bahrain. But what about GCC to China investments? GCC to China investments has also been significant in the past few years. For example, here in this chart, we show that China has been the largest destination for GCC outbound FDI, attracting roughly $6 billion worth of investments in 2014. This is a significant jump from the less than $1 billion of investment in 2003. And the same way that Chinese investment in the GCC was broad-based, the same goes to GCC investment in China. So it has included sectors such as, of course, energy, as well as industrial, tourism, agriculture, and financial sectors. In tourism, Dubai-based Jumeirah Hotels has management agreements for 5 projects under development in China, making it the most in any country outside of the GCC. In energy, there are collaborations between GCC companies and Chinese companies. Saudi Aramco and Fujian Petrochemical Company and ExxonMobil jointly invested and constructed a refinery project and petrochemical integration project in Fujian, China. Sinochem, a Chinese firm, worked with Kuwait Oil for a refinery in Quanzhou that opened in 2014. Aramco and Qatar Petroleum are planning a joint venture with PetroChina. However, these energy projects have been limited due to several reasons. In China, there has been a large trend to attract global oil companies such as ExxonMobil, for example, due to the know-how and expertise that they bring to the table. However, GCC energy companies have a lot to offer in this area. Aramco, for example, is expanding its reach outside of Saudi Arabia, as well as other GCC energy companies. And together they can collaborate on whether it's refinery projects or other natural gas projects in China. In the industrial sector, the Saudi industrial giant SABIC has a presence in the Chinese province of Chongqing. In addition, SABIC with China Petroleum and Chemical Corporation Sinopec formed a joint venture petrochemical company in Tianjin. The two sides invested roughly $6 billion in this project. And this project has been completed and gone into operation in 2009. Even in sectors such as agriculture, for example. In agriculture, in 2010, Qatar was the largest investor in the IPO of Agriculture Bank of China, buying roughly $2.8 billion worth of stock. Financial services has also been attracting GCC investment into China. Kingdom Holding in Saudi Arabia, as well as Saudi Arabia Al-Aziziyah Commercial Investment Company, have both purchased roughly $2 billion worth of shares in the Bank of China. Another example is Qatar National Bank having a significant presence in Beijing. In addition to that, Qatar bought a 22% stake in CITIC Capital, a state-backed private equity firm. Then in 2014, Qatar Investment Authority and CITIC Capital agreed to invest $5 billion each in projects in China and elsewhere in Asia. Through these examples and through this list of different opportunities, I'm trying to just explain that China cannot be seen as one destination of investment, and it cannot be seen as one sector for investment. China has to be looked at as different provinces offering different investment opportunities and having different structural dynamics, as well as different growth trends, as well as different sectors within each province. A big mistake would be to look at China as one large investment opportunity. And on the other hand, it should be looked as which provinces would make the most sense for investing in which sectors. In addition to that, a lot can be done in the existing energy relationship between China and GCC. For example, steering away from exporting crude oil, the refinery projects can be tapped into to find high value-added opportunities. Collaborative work between GCC energy companies and China energy companies can have a fruitful and high value-added return on investment if studied correctly. Moreover, a lot of future opportunities are available. Since 2013, China has been embarking on a very large initiative, which is the One Belt, One Road initiative. This initiative aims to promote economic engagement and investment westward from China into Central Asia, Europe, and the Middle East. The GCC countries need to find how they can fit into this One Belt, One Road initiative in ways that increase their outward investment, as well as in ways to satisfy their own diversification plans and steering away from revenue from the energy sector. One thing can be done in this One Belt, One Road initiative is that looking for ways to collaborate together in projects that make sense. For example, the GCC are currently working on several infrastructure projects in the region that steer away from energy-related sectors. One example for that is the GCC railway project, which will help connect the GCC countries. So, for example, a way to collaborate with the One Belt, One Road initiative would be to see how these kind of initiatives, such as the GCC Railroad, can match with the outward reach that China is trying to achieve throughout Central Asia and going into Europe and the Middle East. Finally, the two have looked together into increasing their cooperation through things like free trade agreements. Since 2014, China and GCC have started negotiations on establishing an FTA. Annual meetings were held in Riyadh, Muscat, Beijing, and positive progress was made in several points, including regulation on trade of goods, as well as the actual text of the FTA and the reduction of import tariffs. But still, progress needs to be done. In addition to progress, a strong analysis and study needs to be done on the benefits as well as the challenges to establishing such agreements and to increasing cooperation between the two. For example, One Belt, One Road initiative has some challenges in addition to its benefits. Some challenges include opening up the market and having different alternatives to GCC exports, hence decreasing the reliance on GCC investment as well as GCC cooperation. Therefore, moving forward, GCC and China cooperation needs to be studied carefully to assess the benefits as well as the challenges and look at what the future has to offer. In addition, a lot of different things need to be taken into consideration. For example, as economic cooperation increases, other things can increase as well, such as diplomatic relations between GCC and China. Therefore, this will need to be studied specifically, and the benefits and challenges will need to be assessed in order to create a plan in the future that will help increase GCC outward investment as well as benefit GCC's own diversification initiatives and strategies. Thank you.
Thank